We backtested a quality low-priced earnings screen across 103 quarters on U.S. exchanges 2000 to 2025. The strategy returned 13.9% compound annual growth rate versus 8.0% for the S&P 500. That's 5.8 percentage points of annual alpha. It turned $10,000 into $283,075. The S&P 500 turned the same $10,000 into $72,829. But the ride included a 44.7% drawdown and years where you'd question everything. The universe is all U.S. stocks on NYSE, NASDAQ, and Amex with market cap above $1 billion. This is broader than a pure S&P 500 screen, giving more value candidates across the full U.S. market. At each quarterly rebalance, we filter for P/E under 15, return on equity above 10%, and debt to equity under 1.0. The top 30 stocks by lowest P/E form the portfolio, equal weight. Rebalancing is quarterly on March 31st, June 30th, September 30, and December 31st. Point-in-time data is critical. If we're simulating a trade on March 15, 2015, we use only financial ratios reported before that date. We assume data is available 45 days after the fiscal period ends, which is conservative for most large caps. Transaction costs use a size-tiered model, 0.1% for large caps over $10 billion, 0.3% for mid-caps between $2 billion and $10 billion, and 0.5% for smaller stocks under $2 billion. In the early 2000s, institutional trading costs ran 0.2 to 0.5%. By 2020, they dropped to near zero for retail investors. The tiered model captures this evolution across the full backtest period. The value premium is one of the oldest findings in finance. Basu documented it in 1977. Fama and French confirmed it in 1992. Lakonishok, Schleifer, and Vishny found in 1994 that the earnings-to-price premium was about 4% annually, widening to 7 to 9% when combined with multiple value metrics. Our quality-filtered version should land in that range with improved risk characteristics. The quality overlay is essential. Without it, the low P/E bucket contains stocks that are cheap because they're deteriorating. These are yield traps in dividend terms, value traps in P/E terms. Adding return on equity and leverage filters keeps the bargains and drops the disasters. Properly executed value backtests typically show long-term outperformance, higher volatility than broad indices, cyclicality tied to growth versus value regimes, and extended periods where the strategy looks broken. That last point matters most. If you can't sit through 3 or 4 years of trailing the S&P 500, value investing isn't for you. Here are the numbers from 2000 to 2025. The Sharpe ratio, 0.562 versus 0.361, is the more impressive number. Better return per unit of risk, not just higher raw returns. The strategy beats SPY, the S&P 500 index fund, in 56% of its 103 quarters. $10,000 invested at the start grew to $283,000. The S&P 500 turned the same $10,000 into $72,800. Nearly 4 times the wealth from buying boring cheap stocks. The dot-com bust was extraordinary. The portfolio returned 26.6% in 2000, while SPY fell 10.5%. Then 7.5% versus negative 9.2% in 2001, and 11.5% versus negative 19.9% in 2002. 3 consecutive years of positive returns while the market crashed. The P/E under 15 filter excluded tech bubble stocks entirely because those names were trading at 50, 100, sometimes infinite P/E ratios. In 2003, cheap stocks rebounded at 48.8% versus 24.1% for SPY. That 4-year stretch generated nearly 110 percentage points of cumulative excess return. The 2008 financial crisis hit both sides hard. The portfolio dropped 29.4%, actually beating SPY's 34.3% decline by about 5 percentage points. Financial services dominated the portfolio at the time, and when the banking system nearly collapsed, those holdings took a hit. But the quality filters kept out the worst names, and the diversified value exposure cushioned the blow. Value names then recovered as beaten-down companies got repriced. That's the pattern with value. It can provide relative protection during broad market sell-offs because starting valuations are already low. The 2019 to 2020 stretch was the opposite story. In 2019, the portfolio returned 14.5% while SPY surged 32.3%. In 2020, it lost 11.3% while SPY gained 15.6%. Value sat out the tech-driven COVID recovery entirely. Then the cycle turned again. 36.3% in 2021 and 50.5% in 2024, the best single year in the entire dataset. The table below highlights the most notable years. The pattern is clear. Value generates its biggest excess returns during market stress, while falling behind during momentum-driven rallies. Value runs in cycles. It dominates during and after market corrections, when overvalued growth stocks collapse and cheap companies get repriced. The 2000 to 2003 run and the 2021 to 2024 rebound are textbook examples. It also provides relative protection during broad sell-offs because the stocks are already priced for modest expectations. In 2022, the portfolio lost 10.8% while SPY dropped 19.0%. Not a great year, but an 8+ percentage point cushion matters when everything is falling. It struggles during speculative growth periods when the market pays for revenue growth over earnings. The entire 2010s were difficult for value. The portfolio produced positive returns most years but trailed SPY consistently as tech and momentum dominated. Low P/E screens also create sector concentration. In 2022, financial services held over 53% of the portfolio. In 2023 and 2024, energy reached 40%. A bank at P/E 12 is normal. A software company at P/E 12 is unusual. When your value portfolio is 40 to 50% one sector, you're making a sector bet on top of a value bet. The P/E threshold isn't magic. We tested different cutoffs across 5 rebalance dates. P/E under 15 consistently yields 25 to 114 qualifying stocks, enough to build a 30-stock portfolio without scraping the barrel. P/E under 12 or under 18 produce similar portfolios with modest shifts in sector composition. The quality filters matter more than the exact P/E number. Researchers disagree on why value outperforms. The behavioral explanation says investors overreact to bad news, sell boring companies, and chase exciting growth stories, creating systematic mispricing. The risk explanation says value stocks are genuinely riskier, with higher distress risk, more operating leverage, and more sensitivity to recessions. Our data supports both. The slightly higher volatility is consistent with the risk view. The extreme outperformance during post-crash recoveries is consistent with the behavioral view. Both probably contain truth. The premium persists because it requires patience through extended underperformance. And most people can't do that. The ride is real. 21.1% volatility versus 16.7%, a 44.7% drawdown, and multi-year stretches of underperformance demand conviction. The 2019 to 2020 stretch produced a combined 45 percentage points of excess underperformance versus SPY. Most investors abandoned value at the worst time. The ones who held through 2020 saw 36.3% in 2021 and 50.5% in 2024. But sitting through a 44.7% drawdown requires more patience than most investors have. That may be exactly why the premium persists. Sector concentration is the hidden risk. The screen has no sector neutrality. Real estate investment trusts, utilities, energy, and financials cluster at the top of low P/E rankings. In 2015, 33% energy concentration drove a 14.6% loss. Given the drawdown risk, this strategy works better as a portion of a portfolio than the whole thing. That's what the data shows across 25 years and 103 quarters. The strategy beat the S&P 500 by 5.8 percentage points annually, but the path was anything but smooth. Expect multi-year stretches where it trails. The premium rewards patience. Full results, charts, and the backtest code are on the blog. Link in the description. Run the low P/E quality screen yourself on cetaresearch.com. Subscribe for more backtested strategies every week.